Okay, well, I think we can make a start now. Hello, everyone, and welcome to this webinar to launch the latest annual findings report, Workforce Disclosure Initiative team. I'm James Caldwell, head of the Workforce Disclosure Initiative at Share Action. For those of you who are not particularly familiar with the Workforce Disclosure Initiative, we are an investor-backed programme whose aim is to generate more, better quality, and to a certain extent, more comparable data on how large listed companies look after their staff and their supply chain workers. In common with many other Share Action work programs, we have assembled an investor coalition. Our coalition stands at around 63 institutions with assets under management of over 10 trillion US dollars who stand behind the request that we put to many of the world's largest companies. And since starting out as a small scale pilot project back in 2017, we have generated more new corporate data on workforce issues than anyone else. And this includes topics like pay, like contract levels, health and safety, internal training and development, as well as supply chain transparency, human rights due diligence, and much more. So in a moment, I will hand over to my colleague, Charlotte Lush, to take us through some of the key findings from the last 12 months of the WDI. But I just wanted to highlight two or three highlights from the last 12 months, in addition to our core work of generating new workforce-related data. So in the first instance, it was almost a year ago now that the WDI team completed a secondment to EFREG, that's the European Commission's Financial Reporting Advisory Group. We were in the room at the earliest possible moment to influence the development of the worker-related aspects of the CSRD, the Corporate Sustainability Reporting Directive, and in the last couple of years, influencing global sustainability standards has been a key focus for the team. Secondly, in the last 12 months, I think our investor signatories that I mentioned a moment ago, our signatories are increasingly using the WDI data in a wide range of ways. I think the big majority of our investor signatories find the WDI data very useful as part of their ongoing stewardship and engagement activities. But we've also seen a number of investor signatories in the last 12 months and more use elements of the WDI data as for stock selection, particularly within sustainability funds, or those funds focused on decent work. And lastly, a particular project that we're very proud of. We partnered last year with Nottingham University for a study focused on modern slavery. And that was a really interesting study, which I recommend any of you on the call today with an interest in human rights or modern slavery in particular to look that up. It was a very useful study focused on some UK industries that to date has received relatively little focus from academics. So it's a really interesting study for those who have a modern slavery specialism. It was also very useful from the point of view of the WDI team, because it was the first time that we had acted in a funded project, largely in the capacity as data provider. So it was a real case study in the usability of the data beyond the responsible investment community. So we've got a very sort of packed hour and a half or so for you today, divided into two sections. As I mentioned, in a moment, I will hand over to Charlotte Lush to introduce the findings from the last 12 months. And then I'm very pleased that we have a panel discussion, which is going to be chaired by Catherine Howarth, Chief Executive of Share Action. Over the course of the next hour or so, as the discussion develops, if you have any questions, please do submit those into the chat box, and we will come to them at the end of the panel discussion. So please, if you have questions or comments, we'll try to get to them at the end of the panel discussion. Please do submit those in the chat function here. With that, I'm very pleased to hand over to Charlotte Lush, WDI's Senior Research Manager. Charlotte.
Thank you so much, James. Hi, everyone. I'm very excited to be taking you through the findings from the 2022 cycle of the WDI today. To start with, I'll take you through a quick overview of the WDI and what we aim to achieve. I'll also outline the content and methodology of the survey. We'll then look at an overview of the key figures from this year's cycle before I take you through the key thematic findings from 2022. We have my wonderful colleague Rosie McKenzie on hand in case of any technical difficulties, so please do pop her a message if you have any issues. And as James said, if you have any questions that pop up during the session, please just use the Q&A function and pop them in there, and we'll get to them at the end of the session when we have some time for a Q&A. So now for an introduction to the WDI. So I know for many of you, you'll already be quite familiar with the WDI, but for those of you who potentially are slightly new at it, it can be helpful to have an overview. So the WDI, or Workforce Disclosure Initiative, aims to improve corporate transparency and accountability on workforce issues, provide companies and investors with comprehensive and comparable data, and promote more ambitious disclosure standards around the world, with the ultimate aim of helping to increase the provision of good jobs worldwide. It is supported by an investor coalition that's made up with 63 institutions with over $10 trillion in assets under management. And through our annual survey and engagement program, we generate new data on workforce practices, which our investor signatories can then integrate into their investment analysis, as well as generating practical insights on how to address salient workforce issues. By increasing the volume and quality of data on organizations' workforces, we enable investors to push companies to improve their policies and practices. This ultimately leads to better quality jobs in companies' direct operations and supply chains, improving the quality of workers' lives and enabling investors and companies to benefit from the consequences of good workforce management. So now on to a little bit about how the WDI survey works. So the WDI survey measures the levels of data that companies can provide on a range of different workforce topics. So the survey includes 135 questions, over 240 data points across 13 thematic sections, which are set out on this slide. So it's definitely not the shortest of surveys. So these sections cover the full scope of companies' operations. So we look at governance through to workers in the direct operations and then through into company supply chains as well. The WDI survey is sector agnostic, which means that questions have been explicitly designed to be relevant to all organisations. While there are, of course, some sections that are going to be more salient for particular types of companies, every organisation should be able to report something to each section of the WDI. The survey is also designed to challenge companies' workforce data collection, which is probably unsurprising when there's 135 questions. And as a result, only 68% of the total survey was completed in 2022 on average. The challenging nature of the survey helps companies think about what data they currently collect, how they manage their workforce, and how this could be improved in the future. We do see the positive impact that this kind of more ambitious approach has every year, as we see the overall disclosure rate continuing to increase year on year, which is really, really great to see. So now moving on to an overview of the most recent cycle of the WDI. So this year, the WDI welcomed submissions from 167 companies. So we once again welcomed several new organisations who participated for the first time. But for the first time in the WDI's history, the overall number of responding companies has plateaued and is in fact slightly lower than last year, with a retention rate this year of 81% versus 85% for the year before. From surveying non-responding companies, it's clear that there are several reasons for this, with the most widely cited being a desire for companies to wait for mandatory reporting standards to be introduced. While upcoming mandatory reporting requirements, of course, place an increased burden on staff that are working to generate this data within companies, taking part in the WDI ultimately only supports rather than hinders that process. responding companies provide on average 2.5 times more data than non-responders. The WDI survey therefore offers the perfect opportunity for companies to test, progress and refine their workforce reporting, ensuring that they're ready to hit the ground running when mandatory standards are introduced. Pausing voluntary reporting until the introduction of mandatory standards also means that investors are unable to access the critical information that they need to make informed decisions based on how companies are treating their most valuable asset. Given the increased interest from investors in sustainability topics and the growing priority being placed on social issues, now is the time to raise, not lower, the level of ambition. This is particularly the case given that it's unlikely mandatory standards will provide the depth of information many investors are seeking on social topics, making gold standard voluntary reporting through the WDI even more important. So now looking to those leading companies that took part this year. So these submissions came from 24 countries, and for the 6th year in a row, we saw all GICS economic sectors report to the WDI. These companies' responses covered a huge number of workers. Submissions covered over 12.5 million workers in companies' direct operations and many, many more in their supply chains. The WDI also asked 54 mandatory public questions, the responses to which are made available to the public by default through the WDI website. Companies can, however, choose to make more data available publicly. This year, companies chose to make 87% of their submissions public, an increase of over a third compared to 2021, where companies made 65% of their submissions public. So I will now take you through the thematic findings from the 2022 cycle of the WDI. So looking at our first finding, the 2022 data showed that many companies fail to explain how they're creating rewarding, satisfying jobs, despite the impact that this has on recruitment and retention. So training and development was one of the key areas for employee satisfaction and retention where significant data gaps exist. At a strategic level, companies seem to recognise the value of training and development. 98% of companies explain their strategy for developing employees' skills and capabilities, and 88% explained how the company identifies and addresses skill gaps. However, this wasn't reflected in quantitative information on whether training is actually being provided. Half of companies provided no information on training hours by gender, and non-responders fared even worse. Just 1% published training data by contract type. Wellbeing was also another key driver of employee satisfaction where corporate progress was inconsistent. 99% of companies offer an example of how the company has improved worker wellbeing, and 4 in 5 integrate mental health, safeguarding into job design and workplace conditions. However, 40% of companies don't monitor and report on employee mental health and wellbeing, or didn't say if they do, which is crucial data for assessing whether these initiatives are actually working. Companies are similarly failing to track turnover, another key set of metrics that reveal workforce satisfaction. Overall, companies completed, on average, just 55% of the section on turnover, compared to an average of 70% of all other sections, and it was the second worst answered section in the entire WDI survey. Turnover data was particularly poorly reported when the survey asked for greater levels of disaggregation. For example, less than half of companies provided some information on turnover by contract type, and data was especially lacking for temporary workers, where just 32% of companies provided some information. Despite some low response levels, this was a significant improvement on the level of information that companies that don't respond to the WDI publish, where just 27% publish any information on voluntary turnover, 9% publish information on involuntary turnover, and just 1.3% publish information on turnover by contract type. So moving on to our second finding, human rights aren't treated as material across sectors, with many industries failing to collect enough data. So given the diversity and breadth of human rights issues, there are no companies that aren't implicated in some form of human rights risk, making comprehensive data collection vital. Some sectors, positively, did perform particularly well when it came to identifying human rights risks. 100% of energy and utilities companies identified 3 salient human rights issues relating to workers' rights in the company's value chain. Every human rights issue provided by energy companies was an actual human rights issue. In contrast, only 45% of healthcare companies and 52% of IT companies identified 3 salient human rights issues. Of those risks, 40% provided by healthcare companies and 29% provided by IT companies weren't actually related to human rights, and instead were general business or human resources risks. We also saw that other sectors are failing to implement the practices that are critical when it comes to respecting rights. Only 33% of real estate companies and 55% of financial companies have a commitment to providing a remedy where the company has caused or contributed towards rights violations. This is compared to 100% of energy companies and 82% of healthcare companies. On average, 57% of companies gave an example of how the company provided or contributed to providing a remedy for a human or workers' rights grievance in the reporting period. However, 100% of energy companies answered this question, while just 31% of materials companies did. This is also the case in supply chains. For 4 sectors, financials, industrials, materials, and real estate, less than half of companies monitor whether supply chain workers have access to a grievance mechanism. Less than 2/3 of financials companies assess supplier performance against their own human rights commitments as part of the process for selecting new suppliers, compared to 89% of all other companies. Moving on to our third finding, the possibility of economic, political, and cultural instability and less developed regulatory regimes can feed a perception of developed economies as a safer bet when it comes to social issues. However, when looking at workforce disclosure, emerging markets companies are leading the way in several dimensions of the WDI. On average, emerging markets companies provide greater quantities of more difficult data. So emerging markets companies completed more of the survey overall, answering on average 81% of the WDI compared to 75% for companies in developed markets. 79% of emerging markets companies answered intermediate tier questions compared to 68% of companies based in developed markets. For comprehensive questions, the most demanding in the survey, the gap was wider, with 73% of emerging markets companies answering compared to 56% of developed markets companies. Emerging markets companies also provided more quantitative information across the survey. This was the case for data on grievances reported and resolved, collective bargaining agreements coverage rates, discrimination and harassment incidents, and numbers of workers in the supply chain, among many others. We also saw that emerging markets companies are more likely to explain both the actions and the outcomes relating to workforce risks and impacts. So every emerging markets company explained the action the company had taken or intends to take to prevent and mitigate the salient human rights issues it identified, while only 76% of companies in developed markets did. Similarly, 90% of emerging markets companies explained whether the company has identified forced labour, modern slavery, and or human trafficking in its supply chain, whereas 70% of companies from developed markets did the same. However, we did see that companies in developed markets provided more data on topics where there is more extensive regulation around disclosure, such as pay. So, for example, almost twice the proportion of companies in developed markets provided their median gender pay gap than those in emerging markets, and more than double provided the CEO to median worker pay ratio, with 71% of companies compared to 33%. So now moving on to our fourth finding, which addresses marginalised workers who are often the most vulnerable workers, but are at the same time the least well understood by companies. So contingent workers are a key group of marginalised workers where companies lack important data. Less than half of companies provided data on the total number and or percentage of the company's non-employee direct operations workers. Just 34% of companies provided the number or percentage of non-guaranteed hours employees in their direct operations, whereas in contrast, 3/4 of companies provided the number or percentage of full-time employees, and 70% of companies provided the number or percentage of part-time employees. When asking about workers with vulnerabilities that intersect, companies provided even less data. While 92% of companies provided some data about the gender balance for different contract types, less than a third provided data on the gender balance for non-guaranteed hours workers, who are the most vulnerable because of the inherently precarious and inconsistent nature of these contracts. This is a sharp contrast to information on women in leadership positions, which was one of the most well-reported metrics in the entirety of the WDI survey, where all but one company answered the question. While these figures are concerning, they are, again, a significant improvement on companies who didn't respond to the WDI. Just one non-responding company published information about the gender balance of its contingent workforce. Companies also lack the information needed to understand how marginalised workers are being treated. Only 50% of responders provided some information on the number of discrimination harassment incidents reported and resolved. This is, however, a notable improvement on companies that don't take part in the WDI, where just 13% publish this data. Almost 50% more companies provided training hours for their permanent employees versus their temporary staff as well. We also saw that when companies do have this information, it reveals the less favourable conditions experienced by workers who are vulnerable across a number of different dimensions. So we saw at 1 in 5 companies, grievance mechanisms weren't accessible to the company's non-employee direct operations workers. And on average, male workers received more training hours than female workers, and they had higher internal hire rates as well. So now looking at our 5th finding, we saw that companies lack the data needed to respond to the global economic context of increasing costs and high inflation. Some of the most notable data gaps in the survey related to the lowest paid. This is especially problematic given that these workers are most severely impacted by the cost of living crisis. So 58% of companies didn't provide any data on the percentage of employees whose basic salary is equal to the legal minimum wage. 47% didn't provide any information on the proportion of women in the bottom pay quartile, and 43% didn't explain how the company is working to improve wage levels for non-employee direct operations workers. Even when it's legally mandated, some companies are still failing to gather or disclose crucial information on pay. For example, not all UK responders provided information on the CEO to median worker pay ratio, which 92% of UK companies provided, or the gender pay gap, which 89% provided, despite legislation requiring that these are calculated and reported. However, there have been some really positive developments when it comes to pay. So in 2022, we have seen a rapid increase in disclosure on the ethnicity pay gap. 54% of companies provided this data, which is more than 13 times the proportion of companies that provided it just 2 years ago. This makes ethnicity pay gap reporting almost as widely reported in the WDI as the gender pay gap, which 59% of companies reported. So, disclosed levels of pay suggest that the cost of living crisis will pose real challenges for workers, especially those that are already more vulnerable. The WDI data revealed that in many organisations, wages are too low to adequately protect workers from the most serious impacts of the crisis. For example, almost a third of companies, so 30%, don't pay a living wage in at least one operating location, or don't say if they do. On average, companies have more than twice the proportion of male workers in the upper pay quartile than female workers. Companies also had an average gender pay gap of 24% in 2022, an increase of 7% on 2021, where the average pay gap was 17%. The increase in the gender pay gap is particularly concerning, I think, given that companies are supposedly placing significant energy and resources into diversity and inclusion. The WDI indicator on corporate plans to improve diversity and inclusion received their joint highest level of response in the survey, with all but one company answering this question. The fact that gender pay gaps have increased so significantly in the face of this purported action on diversity and inclusion seriously calls into question the depths and legitimacy of these plans. So now looking at our final finding. So while they're not quite perfect, WDI responders are absolutely leading the way when it comes to supply chain disclosures. So this year, we conducted a detailed analysis comparing the data provided to the WDI by responding companies with the publicly disclosed information of non-responding companies using channels such as annual reports, sustainability reports, public policies, and 401k disclosures. Comparing responding and non-responding companies in this way revealed that responding companies provided a greater volume of more detailed and sophisticated data on supply chain risks and impacts. So 85% of responders explained the action the company has taken to identify and eliminate child labour across its value chain, compared to 32% of non-responders. More than 10 times the proportion of responders than non-responders explained whether prison labour is used in the company's value chain. And 3/4 of responding companies explained the products, services, and raw materials identified to be at risk of forced labour, modern slavery, and human trafficking. For non-responders, this figure was just 6%. There were still notable gaps when it came to companies' understanding of the composition of their supply chain. So while 92% of companies described their supply chain and explained the role it played in the company's business model, this almost halves to 47% when companies were asked to provide the number of first-tier suppliers in each of the company's top 10 sourcing locations. This, however, is still a drastic improvement on non-responders. 12% of these companies described their supply chain, and just 2 published the number of first-tier suppliers by sourcing location. Information on sourcing practices were particularly poorly reported by non-responders, especially when looking at data examining how the purchasing company is taking responsibility for the impacts of its own practices on suppliers. More than 3/4, so 76%, of responders explained whether they assess how sourcing and purchasing practices allow suppliers to meet their workers' rights commitments, compared to just 3% of non-responders. No non-responders explained their approach to incentivizing supplier performance on workers' rights, compared to over 2/3 of WDI responders. This is a particularly important area for data collection, as it's often purchasing companies that have the knowledge and resources to improve supply chain working conditions, rather than suppliers themselves. It's really encouraging to see responding companies increasingly taking responsibility for their role in poor working conditions in the supply chain with each year that the WDI runs. But it is really concerning that so few other companies seem to recognise the central role they play in driving better practices. Perhaps unsurprisingly, we also saw that the greater levels of data provided by responding companies is accompanied by better reported supply chain practices. So 84% of responders assess supplier performance against their own human rights commitments when selecting new suppliers, compared to half of non-responders. We also saw that 74% of responders discussed the action they've taken to mitigate and manage risks to workers' rights, compared to 24% of non-responders. So that wraps things up for the overview of the findings. Thank you so much. If you have any further questions about the findings or anything related to research and WDI, obviously please pop them in the Q&A function and we'll answer them at the end, or please don't hesitate to drop me an email. So I will now hand over to Catherine Howarth, CEO of ShareAction, and our wonderful group of speakers for our panel discussion.
Thank you very much, Charlotte. Good afternoon, everyone. Big thank you to Charlotte for taking us through some of those really fascinating highlights and findings from this year's data, not only findings on the substantive underlying performance of companies, but on the whole reporting landscape, really helping to understand how companies are thinking about the whole question of corporate sustainability reporting in the area of the workforce. So I'm really delighted to spend the next bit of our session together sharing a conversation between a number of people who, from different perspectives, but all with a great deal of expertise, are engaged with either WDI directly as a user or as a reporter, as a corporate reporter, or from the trade union movement, from the ISSB, which is, of course, an incredibly important new player in the global reporting landscape. So let me introduce them one by one, and I'm going to ask each of them to just say who they are, their organisation they work for, and maybe just a sentence or two about their interest in and connection to WDI and the workforce reporting landscape. So let's start with Richard. Welcome, Richard. Great to have you with us. Why don't you just give us a teeny tiny overview of your role and the relationship between WDI and the interesting work that you're doing at ISSB?
Thank you, Catherine. So I am a member of the ISSB. There are 14 of us. We're a global bunch constitutionally, we have to be. I'm the only one from the UK. There's a small number of us from Europe. We've been working on 2 standards that will both be issued at the end of June. One's a general disclosure standard, the other one's a climate standard. So we have not yet focused on the kind of issues we've just been talking about, but we're about to. And our agenda consultation exercise, which we're about to issue, is going to ask for stakeholder views on nature is one theme, but then human capital and human rights are the themes 2 and 3. And there's a 4th theme we'll ask about, which is broadly about integration with financial reporting. So everything that's just been discussed is about to become a core discussion issue for us.
Wonderful. Good. We'll get into a little bit more detail on that in a bit. I'm next delighted to welcome and introduce Chirag Mehta from Quantum Asset Management, who are both a signatory as an investor, but also a reporting company. So can you just introduce yourself and your relationship to the WDI and your experience briefly of it?
Sure. Thank you, Catherine. So as you alluded that we are a signatory and a reporter as a corporate to WDI. To give an introduction, I'm the Chief Investment Officer at Quantum Asset Management, and at our parent, Quantum Advisors, we manage money for foreign institutional investors investing in Indian markets. These are like the pensions, sovereign wealth funds, and university endowments. We think that, we think that we are torchbearers of sustainability when it comes to Indian markets, and we want to bring global best practices to the Indian markets. And from that perspective, we find WDI as a significant value add from a social reporting or workforce reporting perspective. And we wanted to walk the talk and lead from the front. So we kind of went through our own assessment first, learned what are the challenges to improve disclosures, and we kind of improved our scores. And now we are taking that engagement to our portfolio companies to ensure that they report to WDI and over time improve on their disclosures and practices from an ESG perspective. So that's our association.
Thank you very much, Chirag. And next, Oliver Wilcock from HSBC Asset Management, who has been a signatory of the WDI for quite some time, and I think an active user of the data. Just love a brief introduction before we ask you to say a bit more in a bit more depth later on in the session.
Sure, thanks, Catherine. Hi, everyone. Yeah, Oliver Wilcock. I'm in the stewardship team as an ESG and stewardship analyst at HSBC Asset Management, and we run global portfolios across lots of different asset classes and regions. And I think we've been a participant in the project for a number of years, and I've led on it for the last couple. And for us, really, we think that better workforce data and workforce enhancement is a real key part of sustainable investing now and going forward, and it's really aligned with our theme of inclusive growth and shared prosperity. And I really agree with what's already been said about how useful the data set is, but I'd also just add that I think we've often used it as a means to get an engagement going on workforce with companies, because you can't really engage too much with them until you know a lot more about what's already present with them at the company in terms of the data and their practices. So we've often kind of used it as a tool to get the ball rolling, and that's been quite useful for some of our more junior analysts who are new to the industry and new to engaging on social issues especially. So it's been really good to have the tangible ask of an investee company joining the WDI, providing the data, and then we can start to pick it apart and have a more kind of longer term engagement off that.
Really interesting. And then very warm welcome to Rachel Hargreaves from Uni Global Union. Rachel, you give us a little introduction of yourself and your role.
Thanks, Catherine. So I'm an investor engagement advisor at Uni Global. And for those that don't know us, we're the Global Trade Union Federation for the skills and services sector. So we represent more than 20 million workers across 50 different countries. And when I say service sector, it's quite broad. So we cover everything from ICTS to retail, post and logistics, care, and finance itself as well. And our role as a global union is to bring together trade unions from around the world to work together to correspond to the global nature of many multinational companies. And my role is then to bridge all the work and insight Uni has from doing that work to the investor community. And for where the WDI comes in, what I hear from investors all the time is exactly what Oliver was talking about, is that they need more data before they can start to engage with companies on some of these workforce issues.
Very interesting. Thank you so much, Rachel. Then last but certainly not least, James Caldwell, who opened the seminar up and has been at the coalface of the WDI for a very long time. James, very pleased to have you part of the panel. I think you sort of almost have introduced yourself, but do you want to do so again for a moment, maybe?
Thanks very much, Catherine. Yes, I'm happy to, and I should say I'm sort of filling in for Rosie McKenzie, who couldn't be here in a speaking slot. There are many reasons why it probably would have been preferable for Rosie to join rather than me, but an obvious one, as people can see, is that it's upset the gender balance. So apologies for that. Rosie will be returning to another webinar very soon. But as you said, Catherine, yeah, I've been with the WDI since 2017, and so have been involved with and latterly overseen as head of the programme some significant changes over that time. But as I said in my introduction, we see our core role as generating the new information, which we've already heard from some of the panelists is lacking. That remains the key goal of the WDI.
Great. Well, now I'm going to take a few questions, pose them to different members of the panel. Oliver, I thought I'd start with you, just on how you as a firm see the current landscape for workforce reporting, and what role that it plays in HSBC's analysis and stewardship. I mean, you've touched on that a bit, but it would be really helpful to understand a bit more about how this data is kind of used and operationalized in the process of investing on behalf of millions of pension fund savers and retail investors and so on.
Yeah, sure. Well, I think on the first point, I think what has been pleasing is generally over the last few years, we have seen more workforce and social reporting come into companies' reports. And, you know, that has varied a lot by company and by sector and country, but generally there has been more. It does seem like it's still quite arbitrary what gets selected, and perhaps not, and perhaps it's not at the environmental reporting kind of level where it has become more standardized, around things like scope 1, 2, and 3. Maybe to give an example, one thing that we do think is really interesting and something that was referenced earlier in the report findings is employee turnover. And so you know, I've seen turnover reported monthly, which obviously makes it look very low, and it's kind of in the small print. Annually, the company might give the industry rather than the company's own itself. So I think that gives you an idea of quite how much further there is to go on this topic. In terms of how we use it, I mean, you know, we have thousands of holdings, so you know there is only 167 companies disclosing right now, so we can't use it in, you know, in every product universally, blah blah blah. But I think what it has been quite useful to do is when we are engaging on companies in a particular sector where we know there's someone who's already disclosing in that sector or industry too, we can kind of look up the data set that we all get access to as members and sort of look what challenges they faced, what areas they're not disclosing on, and then kind of bring that into the design of the engagements we're going to use, going to talk to the company about. So that's one way. I think another way, more on the research side, is where we've seen, you know, a workforce issue or a broader social issue really create you know, challenge for the company, both operationally and in terms of the share price. It's sometimes interesting to roll back to that industry group within the survey and see were there any kind of red flags in other companies that we might have spotted that can be used to learn going forward. So that's another way, really.
So that's so interesting. I mean, it's wonderful that you are finding fantastically relevant uses of the WDI data, despite the fact that it is a very small portion of the global workforce that is so far taken the time, trouble, and courage to report to the WDI. Because, of course, I think what companies fear, apart from the sort of workload involved, is that it's going to expose them. And of course, but at the same time, we see these really powerful and very positive data points that show the relationship between disclosure and good practice is quite strong. Richard, let me come back to you. The ISSB is a fantastic and very much needed initiative in the global ecosystem for corporate reporting and also sustainability more broadly. I mean, you've talked about the fact that there's going to be a consultation coming up in which human capital is one of a potential set of options. Maybe maybe it'd be great if you could say a little bit more about how ISSB and its members see workforce reporting. I guess our perspective at Share Action is that this is absolutely critical to sustainability and responsibility performance, and really matters to investors and ultimately to the pension savers and human beings that form the sort of ultimate investor base for a lot of the institutional investment community that will be users of ISSB data. But I also wanted to explore with you how ISSB sees the voluntary reporting initiatives that have paved the way and continue to kind of go into a lot of depth in many cases, and how what's the relationship as you see it between initiatives like WDI, but also CDP and others relative to the hugely needed and welcome developments on mandatory reporting.
Right, so two elements to that question. One is sort of what makes us tick and what do we focus on, and that is relatively straightforward to actually very straightforward to answer, which is that we are focused on information that is useful to investors. End of story. Right, so we have exactly the same materiality lens that financial reporting has, financial accounting has. You know, if it's if information is not generally available and it's capable of making a difference in the decision making of investors, debt or equity investors, then that's within scope for us. So if any aspect of human capital, human rights disclosure is material to investors, and there isn't the requirement already, then that's the focus for us. Notice we're policy agnostic, right? So we're not trying to shape corporate behavior. We're not trying to implement public policy. We're not trying to tell companies what they should do. The mandate for us is to enhance the consistency and comparability of disclosure in a way that helps investors. So the lens is very clear and straightforward. On building on other frameworks, I would say existing practice and other frameworks are incredibly important to us. You know, you can't just create a reporting standard out of nowhere. The same is true for financial accounting standards back in the day. You know, they didn't just come from nowhere. They were in effect codifying and making more consistent and raising the bar for existing disclosure. And the same is true here. So you see that in our climate standard, right? You know, our climate standard, when it comes out, S2, is explicitly designed around TCFD. You know, the structure is TCFD, the fundamental reporting requirements build on TCFD, and they also build on the existing requirements of other standard setting bodies that will be familiar, sort of SASB and GRI and so on. And exactly the same is going to be true here. Yeah, so the themes that were covered in your survey are pretty similar to the themes that you find covered in ESRS or in GRI and SASB and elsewhere, indicating that it's in many ways a pretty well-developed field. And our challenge is not to reinvent the wheel, it's to take existing disclosure and in a sense what works and put it through the lens of our due process, which makes rigorous and comparable and auditable and so on disclosure mandatory, and therefore to a higher standard than we have currently.
That's a very, very helpful response to the question. And we James, maybe speak to this in a minute, but we were very pleased at WDI, Charlotte mentioned this earlier, but to sort of feed into the process of developing European corporate reporting standards and bring, you know, the years of experience that have been built up at WDI and support the process which of developing those European standards. And I guess it's very clear that we would love to see the depth of expertise that has been built at WDI help to shape the most effective and well received human capital reporting standards in due course. And whilst there's only so much capacity at the ISSB, so I guess what you're looking to for investors in this upcoming consultation is some response on prioritization. But ultimately, I find it hard not to imagine, and I think WDI is a proof point of this, that there is significant investor demand for corporate reporting.
Yeah, it's worth just saying on the responding to the consultation process is a really important part of our due process. So we had 1,400 comment letters on S1 and S2, and there's a really comprehensive and rigorous process of going through those. It's not a process where the most responses on a particular issue give that issue greatest weight. The responses are evaluated for quality, essentially, so how much they contribute to what we're able to do, and they're judged on that basis. And so the more a response is able to demonstrate investors need this information and there is a deficiency in general purpose corporate reporting currently, and here's where the deficiencies are and here's what you can do about it. So the more it the more it feeds into our core purpose, the stronger the response is. So I'd very strongly encourage a response to the consultation.
Yes, well, we certainly will support and encourage the WDI coalition members, signatories, to contribute in a really fulsome way to the upcoming consultation. We're very positive about the developments and particularly that upcoming consultation that looks beyond climate. So James, let me just bring you in a little bit to sort of speak from WDI's perspective about the important global developments that are underway in terms of mandatory reporting, and maybe talk a bit to WDI's theory of change in the context of those really exciting and positive international developments.
Thank you, Catherine. You're really happy to. And as you say, Charlotte, who people heard from earlier on, and another WDI team member did complete a 6-month secondment to EFRAG at the time that they were developing the CSRD. And I suppose in terms of, well, there are lots of reasons why we were invited to be in the room at that stage, and one of them is that institutional investors have been central to the development of the WDI since it was founded. We have been through several iterations of the WDI survey by now, and we are at a point where we feel very confident that, despite, as we've heard, it being a very detailed, quite lengthy survey, it's definitely at the ambitious, challenging end of the spectrum. We're happy at this point that every question within the WDI survey is endorsed by our signatory group. Now, of course, not every investor signatory is interested in every metric within the WDI survey, but by working in a sort of a coalition, we have been able to demonstrate the value to investors of a very detailed survey. And I think I don't want to sort of go into too much detail about what we may do with ISSB, but I think one thing that we certainly will be making very clear is that when WDI sort of makes particular recommendations, we're not solely doing that as an NGO with a particular worldview and a particular set of changes that we want to bring about, but we're doing it in cooperation with a very large international coalition of institutional investors, which ranges from very what you might call sort of progressive investors, so including trade union pension funds and ethical asset managers, right the way through to some of the largest mainstream financial institutions in the world. And by having that broad coalition to stand behind everything we've done, I think that's one really critical aspect that allows us to get a seat at the table with people like EFRAG, and we will see, hopefully, to have a positive engagement with ISSB this year and going forward.
Thank you. Chirag, I'm going to come to you. And one of the things that was absolutely terrific about Charlotte's presentation was highlighting that companies in the developing world are doing particularly well when it comes to some of the reporting metrics. So that's really interesting, and it speaks to, I guess, understanding the motivations of both companies and investors in economies such as India, where you're based. So I just wanted to have you reflect on maybe on how workforce conditions are seen. Is it a risk issue? Is it a responsibility issue? Is it a bit of both? How are these topics that are covered in quite a bit of detail in the WDI survey relevant to you, both as a company and an investor?
No, it is extremely important for us to look at these. For example, there is an Indian company that we were looking at for assessing on ESG, and we didn't find enough data for that company in Indian landscape. And we kind of looked at, because it's a global apparel company, we kind of look at their practices globally from sourcing perspective, and it gave us good insights into how we can use that in the Indian landscape, and also influence the Indian company to report, given they were already reporting at the global level. So I think it gives us a good amount of engagement and knowledge, right, from looking at global players disclosing and also Indian players. And I think the regulations in India and the investor push in India is very, very real. So if you look at the SEBI, which is a market regulator in India, has compared top 1,000 companies in India from this year to disclose a lot more granular data on ESG metrics. So they have spelled out each and every metric in terms of the disclosure that will be required. So if you look at what was a boilerplate disclosure so far, is going to be a more granular disclosures going forward. And we had an opportunity to involve WDI at the government task force level to kind of ensure that the workforce reporting also is in sync with global best practices. So we are engaging with all regulators with the best global practices, be it the TCFD, CDP kind of standards out there, or be it WDI on the social side, to ensure that the regulations in India shape up very well. So although it's far from perfect, but it's evolving towards being a good standard from a reporting perspective in India. One important issue that we also face as investors is the harmonization amongst different standards. Maybe someone like ISSB coming out with their prescription would be acknowledged globally and could help in harmonization of the very standards that prevail today. So overall, I think from an Indian standpoint, we are seeing that the need for sustainable finance significantly being needed for a country like India. And India is doing its bit in terms of reporting, disclosures, best practices, also improving over a period of time. So overall, we are seeing it move in the right direction. And I think from a WDI perspective, we will see more signatories or more reporting from Indian companies to WDI from next year. We are engaging with them along with WDI. And I think there is a lot of sensitivity amongst the companies to report and achieve the best global standards prevailing out there. So I think there is the necessary push, and I think companies are positively responding to that.
Well, let me just thank you for your consistent leadership. We've really, really appreciated the relationship with Quantum Asset Management, and it's absolutely excellent that we're being able to, bring the insights and the knowledge and the expertise from WDI to the Indian supervisor regulator and feed it in at that point. Because, whilst we all absolutely love the global ambition of ISSB, and nevertheless, we need supervisors and policymakers and regulators in different markets to take a lead and ultimately adopt those standards, and to take an initiative earlier where they can. So thank you for sharing what's happening in India. Really, really encouraged by that, and just delighted that we've been able to feed into it. Let me come on to Rachel for a bit more colour, insight and depth on how the union movement sees these both voluntary and mandatory reporting developments, and also maybe share with us, Rachel, kind of what the topics and metrics within the WDI that really matter for workers, their well-being and their dignity.
Thanks, Catherine. So yeah, when it comes, we see the need for these voluntary sort of data frameworks, because there's a real lack of reporting from companies when it comes to concrete data points such as turnover rate, health and safety statistics. What we often see is, you know, companies relying on their own employee satisfaction surveys or scores from third-party awards that they pay for, you know, the sort of ones that rate the best or the greatest places to work, and claiming that that's an insight into their workforce practices rather than disclosing clear data points, and that see lots of issues with investors relying on that. Firstly, there's a lack of transparency. It's really unclear how these scores go into these employee satisfaction figures. And often, if you do know what questions have been asked, they're subjective, to sort of frame it, make the company look more positively. Us as well, I think there's a lot of concerns from workers around filling these out and their anonymity. So are they going to answer honestly if they work in a workplace where they're scared of management? Probably not, which means it's then not a good indication of workforce practices at that company. And I think this is a problem for all data points, but particularly for worker voice. And I say there some of the metrics we're particularly interested in as a union. Obviously, I'm going to sort of highlight freedom of association and collective bargaining as sort of key things investors need information on. And I think most importantly, actually collective bargaining coverage, which is a statistic that's covered and captured by the WDI as well. And one reason why I say this is such an important data point is that freedom of association and collective bargaining are enabling rights. So this means they foster respect for lots of other human rights, including gender equality, health and safety, decent working conditions. And additionally, the presence of trade unions can also help improve a company's due diligence, as they really have that sort of on the ground insight into workforce conditions. So that's why I'd say that's sort of one of the most important data points that I'd pull out.
Very helpful. Thank you, Rachel. I'm also very much looking forward to continuing to work with Uni Global Union and you on this agenda. Oliver, let me come back to you briefly, just on, HSBC Asset Management has been, I think, I don't know how many years, but an early signatory of the WDI. And we've been very pleased that the number of investors has grown over time. But there's a lot of scope for more investors to pile in and really get behind these initiatives. And, you know, the more investors that are engaged and signatories, but not just engaged, but also actively in dialogue and talking to companies about their about whether they will put the time into reporting to the WDI, that of course really drives uptake, and we saw some of those stats earlier. I'd love your reflections on what's needed to raise investor interest in this agenda, and how you see maybe the landscape going forward in terms of investor engagement with the S of ESG in general.
Yeah, sure. I think for us, it's very much a long-term investment, because clearly, as I referenced earlier, we do need more companies to join before you get to that critical mass. But I think in the short term, one really valuable gain we've had from it is sometimes being able to meet quite different people at our issuers, at our investee companies. And so Actually continuing on with the emerging markets theme, with the GEM equity and frontier equity teams, we have spoken to a variety of names in Africa and Asia and India about participating. And sometimes we've been quite quickly given access to the head of human resources or the head of kind of data for the company, and been really fascinating to get their read on how their organization functions and the data that's collected already, and actually quite thrilling in some ways to hear how keen they are on the WDI and how quickly they get what it's about. So maybe that's partly, that's an anecdote that answers why maybe there's been some good results from EM on the survey already. So I think there are some short-term gains to be had that other investors could realize, and as I've already mentioned, we have found it a useful kind of building block engagement tool for opening up a longer discussion in future, and yeah, in the long run we just hope that there can be more companies participating, so that the value of the survey continues to grow.
Great. Well, let's spend a few minutes on the relationship between climate change and workforce situation. And obviously a phrase that's much in use these days maybe doesn't resonate with everyone in every part of the world, but it's just transition. Actually, I was recently at an event where there was a very, very powerful testimony given by someone from India about how climate impacts are driving internal migration within India, and creating a huge amount of vulnerability for people that then find themselves needing to take kind of work at any price, and with very significant costs, and so I thought that was just a very, very powerful insight into the relationship between climate change and social vulnerability. So I just would love maybe Rachel, if you're happy. Don't know where you've Rachel's disappeared. Okay, we can't be Rachel. Let's have Chirag, if you're happy to your reflections on this relationship between the two, and maybe bring that back to this question of corporate reporting and how we can kind of build, I guess, more social nuance perhaps into some of the climate reporting that we will get, but ultimately also connect the dots and recognize that there are very significant risks for workers in industries that are going to disappear, but equally well, huge opportunities, but also risks for people in some of the fast growing. I mean, the solar industry globally is on an extraordinary growth trajectory, but with some big questions being posed about workforce conditions internationally in the solar industry. So I'd love your reflections on those connections.
Sure, Catherine. If you look at, when you spoke about just transition, I think there couldn't be a bigger example than India from a just transition perspective. If you look at India faces a twofold challenge. One is to ensure that it grows sustainably, and it also has a cleaner, greener pathway going forward. At the same time, it has such a big population below the poverty line, which will need access to cheap sources of energy, so that they kind of lift above and come above the poverty line. So there is a need of both for a country like India. And the simple answer to that fact is there has to be support from developed countries towards technology transfers and investments made into countries like India. Because we think countries like India are ground zero when it comes to climate change. Because if you can stop a virus from entering your country, but you can't stop a greenhouse gas emission emitted out of India to coming into your backyard. So from that perspective, I think the world is interlinked from a climate perspective. And also from a social perspective, I think there are various challenges if you were to meet those climate goals. So overall, the world is very, very interlinked, and these factors of E and S are also very, very interlinked from that perspective. When it comes to ambitions of growing into green energy, from taking India's ambition from 175 gigawatts of energy to 500 gigawatts, it will require huge amounts of land because that solar energy is intermittent, and therefore you need to have excess capacity so that you kind of meet your peak load factors. So overall, from that perspective, we might not have that much land. We might have to compromise on agriculture, which will also have impact on livelihoods of people in social in the rural areas. So there is a bigger challenge at hand. And I think the easy answer is to work in harmony or with the developed world, and developers seeing that as an investment, not as charity, and overall ensuring that we kind of move to a better pathway from a environment perspective and also from a social perspective. So overall, I think that the working conditions, or be it India being the supply chain to the global world, all those improvements are happening in India as we see. There is sensitivity on companies that are part of the global supply chains to ensure that they have better conditions. They have looking at diversity in a bigger way. They are looking at human rights due diligence. So those factors are being seen, but we are still a long way away from where it should be. So overall, if we are serious about looking at addressing environmental issues, looking at social zero, and we need better disclosures and better practices from these regions.
Very helpful, very, very interesting. Richard, maybe I'll pick this up a bit with you as well, because I mean, you mentioned that the upcoming consultation will ask for thoughts on human capital, but also human rights. And I think one of the things in the WDI surveys, because it focuses on direct operations, but also global supply chains, we see those issues extremely indivisible. We also see these powerful links between climate-related risks and impacts and social risks and impacts. And I would love your reflections on, I mean, inevitably, one has to sort of put things in boxes to an extent, but equally well, that can also confuse the real picture in a way. So I would love your reflections on that. And then Rachel, will come to you for thoughts on just transition in a moment. And then I really want to encourage the audience to put their questions in the Q&A so we can open things up and really interact a bit more with the audience. Richard.
Yeah, I think I just identified two big themes in all of this. One is that corporate reporting has different lenses depending upon the audience you're reporting to, right? It sounds obvious, but actually it's really important. So the impact on your impact on your workforce or in your supply chain and so on is useful material information to investors to the extent that it affects the reputation of the firm or the supply chain risk, whatever it happens to be, or the attractiveness of employees to work in the firm. So one lens is reporting to investors, and for us, that's the lens. The other lens is reporting to society, right? Is reporting to workers and communities themselves, and that's a very different lens and the two do tend to get conflated. And even when we talk about reporting impact on society, more often than not, we're talking about reporting on impact on society in order to report on the performance of the company. And I think in this social space, the potential disconnect between those two audiences is high, which is why you actually need, in my view, both an impact-oriented reporting and investor-oriented reporting. You need different stakeholders to be able to have an understanding from their own perspective of the company's activity, and you can't. It's a very indirect. If you want to hold a company to account, as it were, for its actions on society, it's a very indirect lens to say, we'll hold you to account, but only insofar as your investors care about it affecting their financial performance, right there. So the two lenses are, I think, incredibly important in their own ways. Ours is the investor lens, GRI and ESRS, both. GRI is explicitly the impact lens, and ESRS is kind of both. That's the first general theme. Second general theme is the relationship. There's obviously relationships between social and environmental in the current time period, what feels most important to me is the dynamic over time in the relationship between the two, and in particular, the consequences for social of failing to perform on environmental. So, you talk about migration in India, the consequences of failing to address climate change and biodiversity loss for migration and conflict and famine and all the rest of it are immense. And so it's risky in my mind to focus on the social now and the environmental now, rather than also thinking about that dynamic. Because if you don't fix the environmental now, the social problems will be on a different scale altogether from what we have now.
Indeed. Indeed. Very interesting reflections. I mean, it's obviously it's a very big debate, and one we could maybe continue to have. But I think the notion that investors' interest is sort of exclusively financial is I think questionable, because the reality of who the institutional investment community act on behalf of is it's people, and when they're questioned and their sustainability preferences are understood, they're extremely interested and indeed self-interested in corporate responsible behavior. So I think, one of the ways that the financial community has sort of lost its way a little bit is to be less accountable and engaged with the underlying interests of people on whose behalf they act. So it's a very, very interesting dynamic debate. Rachel, why don't you just give us a few quick reflections from the trade union point of view on just transition, because it's something that I know the union movement is engaging with very intensively.
Thanks, Catherine. And yeah, I guess my main point sort of builds on what Richard just said about the need for different stakeholders when looking at the just transition. I don't think there can be a truly just transition without taking into account worker voices and how they're going to be affected by the change and what they think will be the best sort of solutions to implement. So again, it pulls me back to the earlier point about data points around freedom of association being really important for investors to collect when they're looking at data and how companies are managing this transition as well. I think it's quite interesting from the representing the services sector. We're not necessarily a sector you automatically think of when you think of just transitions and the risks. You may think to look more closely at traditionally high carbon intensive sectors or those sectors that are offering sort of alternatives. But there's growing jobs in the service sector, and I think investors must make sure whatever alternative jobs there is provides decent quality conditions and pay. And we've seen lots of investors be interested in investing in the care sector, which is a sector we work closely with at uni, because they think it's a low carbon sector, but that it's a sector with lots of workforce conditions. So I think I would just say from the union point of view, asking companies how they're managing the transition is really important for those companies directly involved. But I think it's important for investors to ask for this data from a range of sectors and make sure that the alternative jobs that are available are providing decent working conditions as well, and don't just sort of ignore other sectors when they're focusing on the just transition. It is something that affects every sector.
Thank you, Rachel. Well, let's take some of the questions that have been coming through. So there's a question from Joanne Bauer about what explains why emerging market companies perform better than developed market companies, which is certainly a really striking and positive, intriguing finding. I'm going to ask Charlotte to put her video back on and maybe give us some further reflections on that, and then open that up to anyone else on the panel for any reflections they may have around or insights they may have on that intriguing finding.
Yeah, thank you, Catherine. I think that there's a couple of reasons why this is the case. I think the first is potentially there's a slight sort of selection bias. So we have more developed markets companies responding to WDI than emerging markets companies. And I think that means that the emerging markets companies that we get tend to be sort of leaders in the space. But I don't think that that explains, as you've all seen, some of those differences are quite stark and quite significant. And I don't think that that's explained just through, we've just kind of got the few very best emerging markets companies, especially because broadly we have all the companies that respond to WDI tend to be much, much better than companies that don't respond. I think the other reason, one of the big reasons why we see it, is I think that emerging markets companies seem to be much more cognizant of workforce risk as something that is actually material to them, and they take that much more seriously. I think a lot of what we've seen in disclosure from companies in developed markets in WDI is they very much see it as not their problem, and a problem deep in their supply chains for different parts of their operations. And so they kind of think, well, I operate in the US and the UK, apart from D&I, what's the issue for me? Like, what's material? Like, these workforce issues aren't material for me. And I think that companies in emerging markets have actually a much broader, or we saw in the WDI, a broader and more expansive understanding of the ways that workforce risk can materialize, and their disclosure matches that, which is a really positive thing. And I think it's a shame, because a lot of these countries in developed markets will have more access to bigger resources. They should be able to have really, really phenomenal kind of workforce reporting things, and there are definitely some serious gaps. So hopefully it serves as a motivating factor for them to get a wriggle on when it comes to disclosing more.
Very interesting. Thank you so much, Charlotte. Would anyone else like to share reflections? Sure, you did a little bit already, but and you may want to say more at this point, but I'm really interested in anyone else's reflections on the very high quality reporting, relatively speaking, that came through from emerging market companies that report to WDI. Okay, well, Charlotte, go on, Chirag. Yep.
Yeah, I think I agree with what Charlotte said, right? I think its number of companies are lesser, and they are kind of leaders in their industries and reporting better, having better disclosures and practices as well. So if you were to even evaluate them qualitatively, I think you would get a better result of those companies, reinforcing the point that, they are better at what they are doing. And therefore, there is a selection bias involved between that developing and emerging markets. Because when we assess companies in India, we see a whole spectrum of companies which are good and which are bad at their disclosures and practices as well. So I think it's just the leaders reporting, and that's leading to that bias.
Thank you. So there's a next question, which is about sharing best practices from firms that are reporting well and being transparent and effectively communicating. So again, might give you that one, Charlotte, and that maybe that, obviously there's a whole report being published today with a great deal of information, and there will be a series of events, seminars, and sort of topic specific opportunities for interaction with the WDI data and the WDI team. But do you want to say a little bit more about what you're sharing on best practice, and also what's maybe in the pipeline in available for public consumption and for the signatory investors?
Yeah, absolutely. So I think that when it comes to best practice, I will definitely very enthusiastically point you towards the WDI award winners. So we do have awards for responding companies, and we've had some companies doing really particularly well in that. For example, Standard Chartered have been fantastic, Centrica have been fantastic, but there is the full, you can see the full list, and you can go through all of the public WDI data. So it's all there for you to kind of see how they've been doing really well and to learn from that disclosure. We do also publish a best practice guide as well. So that has all of the kind of best answers we got for every single question in the WDI. So you can go through that as well and see exactly what the kind of best disclosure is. In terms of, I guess, on a slightly higher level, in terms of principles and what I think of as the distinguishing factors when it comes to really leading companies, I would say that it is companies that provide more quantitative data. That's the kind of what we see as the first step between being like just getting into this and really starting to become a leader. almost every company that responds to the WDI can tell us about their plans, can tell us their policies. It's a completely different story when it starts being about, no, give us like hard statistics. How many workers are in your supply chain? What is your percentage of collective bargaining agreement coverage? All of those kind of things. So that, I would say, is a really crucial determinant of good disclosure. I would also say that disaggregation as well, kind of building on that quantitative point, is really, really important. So not just do you have the number of workers in your supply chain, but can you break that down by gender? Not just how many employees, but can you break that down by contract type? Like wage level data by gender. All of that kind of stuff is really important for just adding that extra depth and nuance and being able to track ultimately impacts on workers, because it's those impacts on workers that feed back as impacts on investors. And so that's why they're interesting and important. So yeah, I can share links in the chat now to all of those resources that I mentioned in terms of kind of best practice guides and things like that. Yeah, and I would thoroughly recommend just having a look through the WDI data set, and of course through the findings report as well, for a kind of deeper dive into what we're seeing where companies are doing really well.
Thank you very much, Charlotte. Very impressed. I'm really glad that that question gave you an opportunity to share what is available, which is a very, very rich array of things. Now we've got an excellent question, which is about disclosure by companies leading to kind of better ESG scores, rather than necessarily reflecting the quality of their underlying practice, risk management, and so on. And I know, and there's obviously on the climate agenda side, and a sort of I know there's been, you know, many extremely polluting companies that have been very good at disclosure and perhaps haven't addressed the underlying risks and impacts, but have scored quite highly in terms of ESG ratings and so on the basis of disclosure rather than underlying practice. I'd love reflections perhaps from everybody on the panel around that challenge, because it's certainly one that's exercising regulators, very, very live issue, but obviously is hugely relevant to investors, that we do see real impact and risk management, as opposed to just a big focus on winning points for disclosure. Oliver, why don't you tackle that one perhaps, and then we'll pick up some other views.
Yeah, sure. I think one anecdote I can share actually that came out of your the WDI award ceremony was one of the winners saying how doing the participating and completing the survey had given them an idea of some gaps and some issues they had that they didn't really realize, and then they went away and made them the priority. So that really is the kind of, you know, the theory of change working itself out live. And so clearly you do need to do more than just disclose, and that comes down to the culture and the way people are incentivized. But I think that in lots of cases, disclosing more and learning more about your business first is a necessary first step.
Thank you. James, do you want to give any reflections on that quickly, and then I'll ask Chirag, Richard and Rachel to comment on it as well.
Yeah, I think it's true that, you know, technically, as from the WDI point of view, we do applaud firms that disclose more, and Charlotte's just mentioned that we have transparency awards in a number of categories for companies that do embrace this and do disclose the most information. And we know that just as investors have different motivations for supporting WDI and being signatories, companies, of course, also have different motivations for reporting to WDI. Oliver's just given a really good example of the benefits that one company derive from participating. I've sort of been with the WDI team more or less since the beginning, and I'm yet to hear, anecdotally or otherwise, any example of a company participating in WDI in order to get an improved ESG score. I don't believe any of the big ESG data providers are integrating WDI data, or even a simple which companies are responding, which are not, into their ESG into their ESG scores. I'm very pleased to be corrected on that if I'm wrong. I'd be interested to follow up on that conversation. But I suppose I guess the broader point is that it takes a significant amount of time, and in the case of investor signatories, a bit of money to be involved with WDI, because they pay an annual membership fee to support our work. And so I really don't think that in the case of the WDI, whether you're participating as an investor or as a company, I don't think anyone who's doing that is doing that in order to sort of as a shortcut towards anything. It's you know, you can take lots of different views about what participation in WDI means, but it doesn't offer a shortcut to anything, I would say.
Very reassuring answer, and very credible answer. I would agree, and partly because WDI remains voluntary, so you really you certainly don't need to do it right now. Richard, any reflections on those sort of relationships between disclosure and underlying performance, financial and non-financial?
Yeah, okay, just a couple of things. One would be, I think, the importance of not conflating the greenness or brownness of the industry with the quality of disclosure, right? So actually, you can be a highly polluting industry and have really good disclosure on your sustainability transition plan, and that's needed, right? So you could be an industry with a shocking record of employment in your own workforce and in your supply chain, and with all scope for improvement, and you could have very good reporting. Now, obviously, there needs to be credibility and follow up on that, right? So I think in general, sustainability reporting can be done well by a poorly performing firm and badly by a well-performing firm, as it were. The other general thing to say is that there's quite a lot of academic evidence on voluntary reporting being selective. I mean, this is not surprising, right? That voluntary reporting is used by poor performing companies to legitimize and justify and sort of present an image which is not quite true, and so on. And so the need for mandatory reporting is I think pretty clear when if there's any degree of conflict in interest between transparency and the company's own interests, you need mandatory reporting. That said, I think the real value, the real sort of mindset shift in this space is when you get to the stage of transparency being recognized to be in the corporate self-interest. Because so when we actually recognize it as a mechanism to achieve best practice, which will pay off in the end, as it were. That can be quite a brave step to take, but I think it rarely doesn't pay off.
Yeah, great. We're almost at the end of our time, and I think I'm going to make sure that we do end on time. So I'm going to just really thank, well, first of all, I'd really like to pay tribute to the WDI team, because an awful lot of work goes into producing material that's of enormous public interest and of interest and usability to investors, and of course to companies themselves, because a really excellent thing is that companies are able to see how they compare with others. It's very, very useful management information, but it's also investment information, and it has a wider public too. So thank you to the WDI team for all of the hard work that's gone into releasing very, very important data today, but also to everyone from the investment community that participates in this, not just our panelists, but it's been tremendous to have you, Chirag and Oliver on the panel today. And Richard, the work that you're doing at the ISSB is of enormous interest to everyone. Very, very exciting developments and happening so fast. And I think this is a very, very rich conversation happening across the world between the voluntary initiatives, between the regions of the world, and within the investment community about the developments underway at ISSB, and we certainly want to help you make a great success of the ISSB's mission. And I don't want to forget Rachel, who because this is about workers. The Workforce Disclosure Initiative is ultimately about people all over the world who make and sell and produce goods and services for all of us. And those people really count. And many of those people are members of pension schemes who have a real interest in excellent standards of sustainability reporting. So really glad that we had the worker perspective on the panel today. So let's leave it there and just look forward to another tremendous year for the WDI, to the excellent conversations that we have with WDI's signatories, companies, and many other stakeholders. Thank you for joining.